notes you were hiding out in long-term bonds for a while, and that has been a great play this year. Is it going to continue? I'm curious why Treasuries have yet to make a new high. TLT or zero hasn't made a new high either.
Good afternoon, Oliver. Well, we've had actually a good run with Treasuries through the bear market that started at the end of February. You know, if you just look at the 1 month through the initial market sell-off through March 23rd, you know, looking at ZROZ, the ETF that is the PIMCO zero coupon bond ETF, you know, through that period, we had the S&P 500 off 35% and ZROZ, that ETF, up 15%. So certainly a good hedge through that period. Now, you know, we had some pricing dislocations. We had a little bit of rise in yields that even affected Treasuries. But you know, that's been a good hedge, along with gold, and we've had some margin selling that impacted gold as well. But between our Treasuries and gold, those have been pretty reliable hedges through all the carnage that's happened in stocks over the past 5 weeks.
Yeah. Is the hedge still going to work today? We see we've got a bid into the long-term bonds. The one that you look zeros is the 25+ year, many no TLT, 20+. But it's weird, the last couple of days here, David, I wonder if we're starting to, I don't know, I hate to see the idea of that kind of liquidity crunch that we saw at the worst of this sell-off, but I see bonds just not even responding to stocks on the low of the day. I see gold hasn't done squat over the past 2 weeks.
Right, so we have, you know, it's a question of where do we go? And we are still seeing, at least we're seeing Treasuries perform. You know, if we look across the whole bond space, literally mortgage, there was, you know, we went through, it was like whack-a-mole, right, with junk bonds, with mortgage-backed securities, even investment-grade corporates just getting murdered over the past week and a half or 2 weeks. And as I said, you know, Treasuries had a rise in yields. There were some pricing dislocations, but at least we're getting that performance or that diversification that we need in our portfolios. And even today, you know, we're getting a bid in gold, and we're seeing Treasuries perform and provide that diversification in our portfolios with, you know, we're looking at the indexes off between 4 and 7%. The major stock index is off between 4 and 7% today.
What's the risk, David, that we have a similar event where correlations return higher again and we see broad selling across these asset classes? Does there need to be another shock, a surprise from the virus, a deep reinfection in China, or an enormously bad data print? We've already gotten enormously bad data prints, so it seems like right now that's not troubling the market too much. But what in your mind could send us back to that period where it was stocks down, bonds down, gold down, Bitcoin down? That risk, is that past us for sure?
No, I don't think it is. I think that concern is still very much there, and especially if we see another deep sell-off like we saw through March 23rd, we could easily see it, you know, correlations go to 1 again, where everything gets sold, especially if we get to that point where we see the deep margin calls, the huge margin calls, where investors are looking through their portfolio, and it's not sell what they want, but sell what they can, and that, you know, that's when they dip into their gold, even dip into Treasuries, and they're not selling what they want. They're selling what they can, and you know that is a concern. We have a little bit better outlook for bonds in general, and especially higher quality in Treasuries because of what's been done for, you know, what's been done by the Fed to help with the plumbing, to help with shore up the market, so we don't see the seizures that we saw a couple of weeks ago. But we think it, you know, it benefits. That's why it benefits investors to look beyond just bonds or just beyond even Treasuries to gold, and even alternatives, you know, to look at long short funds, other ways to diversify the portfolio beyond those traditional hedges. And you know, when you look at REITs and utilities, you know, typical places that the investors have gone to, you know, those haven't been good defensive hedges in this market either. So that's why we like looking at some of the alternatives like long short funds.
David, I want to get to one of the long short funds that you're looking at right now, CLIX, the retail online short brick and mortar. But I thought brick and mortar was doing okay right now. I thought that the Walmart and Kroger's of the world. Is this just a bigger push into the online names that is helping the index or helping the ETF?
Yeah, the discounters are doing well right now, right, with the environment that we're going into. But if we look at more broadly, at stores like GameStop and Kohl's and Bed Bath and Beyond, those brick and mortar stores are doing miserably right now and have been. If you look at this, this is a good example of a long short fund and a story that when you look at what happened here in this market pullback, one that was kind of a slam dunk that should do well in this environment. As we went into this market pullback and into this economic slowdown, what happened here? The government came in and said, we're going to shut down stores. And they forced even people that might not have been accustomed to or normally would go online to make purchases. You were kind of forced to do that. Probably everyone has found themselves purchasing items online that they hadn't in the past because that's what we're doing right now. So a model that was already underway, people moving more and more to e-commerce and online purchases, was accelerated here over the past month. So this particular long short fund, which is long e-commerce and short brick and mortar stores, was kind of a natural play for this, and it's done quite well. If you just look at a year-to-date return, Clicks is up 13% year-to-date versus S&P 500 down 20%. So the numbers speak for itself. And you take a day like today, it's been about flat today with the index is getting murdered.
Mm-hmm. It's looking pretty good. It's looking real good, actually, right below the high before it started selling off the rest of the market. So very fast and rare V-shaped recovery in this fund that we see. David, I want to get your thought on the story of the day here before I let you go. It looked like China was going to reopen its economy, rebound, and possibly set a blueprint for how we move beyond this virus. Now we get the report from the U.S. intelligence that these numbers are indeed fabricated to some degree. We don't know exactly how or details or how big it would be, but should that mean that the narrative around watching China as a potential bounce back spot is broken? Because I think that's really been one of the glimmers of hope here, is the idea that we can kind of see the other side with China as an example. Does this break that example, or is this just confirming what so many suspected?
I think it's just confirming what so many had suspected. We know that numbers out of China are always suspect, and I will go ahead and say that the numbers were never believable. There was so much out there that made their numbers suspect before we had numbers from Italy that were so high. When we compared populations, it became more and more obvious, and now our population compared to theirs. But that aside, we were investors in China about a month ago because of they were moving to the other side of the coronavirus impact on the economy. They were restarting their economy. Just some of the anecdotal data of at the time we were closing all the Apple stores in our country, they were reopening them there. Their factories were coming online, and there's ways we could measure that, not by them running machines with nobody standing there and power being consumed, but by the pollution index increasing, in the country, things that could be measured. But we know that the country is coming back online, and so that therefore the economy is coming back online. There now is this renewed threat, so that gives us pause on how fast they're coming back online and what our investment thesis should be there. But there is.
And what is that right now, David? For China, do you want to own China stocks?
We're backing away from our investment there because of where we see other opportunities. And just there was a time there with the PBOC pumping massive stimulus into China, into their economy, and therefore into asset prices. We still think opportunity, but not what it was earlier this year.